I'm your host, Ben Lewis, and today we're joined by Tom Meyer, president of Meyer Capital Group in Marlton, New Jersey. Tom is joining us today to talk about a fiduciary standard and why it's so important to you, the investor. Tom, thank you so much for joining us today. I really do appreciate the time.
Thank you, Ben.
So why don't you go ahead and jump right in here and tell us a little bit about what you guys are doing at Meyer Capital Group.
You know, Ben, we try and spread the fiduciary word, and, you know, it feels like it's David against Goliath each and every day. Mm-hmm. Obviously, with the Merrill Lynch rule being peeled and trying to make the brokerage end to live up to their suitability requirements, whereas we're fiduciary, it just feels, unfortunately, that it's still an uphill battle, even with what happened last year. There's a lot of confusion out there, and, you know, when you're a fiduciary and you want to do what's best by the client 100% of the time, it's kind of tough as an independent versus the old marketing billions of dollars that they have that we have to go against. And it amazes me to this day that we still have to talk about what's right for the client, because quite frankly, anybody in this business that sits in front of someone to talk about investments should be a fiduciary.
How does being fee-only, how does that relate to the overall fiduciary bait in terms of how you guys actually provide your service to your client?
Well, obviously it's conflict-free. We get paid by our client first and foremost. That's it. Bottom line. We put all of our cards out on the table. You know as well as I do as a fiduciary, we are required to do that. There's no bias whatsoever. If a mutual fund or a manager doesn't do what, you know, we expect them to do, they're gone. We don't owe them. They don't owe us. You know, we started out, I'm on, believe it or not, my 26th year. My grandfather told me about the fee-only business back in 1982. He was almost like a pioneer back then. I mean, if you recall, back then people were selling loaded funds at that point 8%, 8.5% in some cases. They were selling limited partnerships, and it was all about product. So he taught me back, the day I started, the Dow was at 780. And I'll never forget, he told me, you do what's right by the client first and foremost, and they will come. You know, it's almost like, I forget the name of the movie, but build it and they will come. Well, you know what? He was absolutely correct. Yeah, Field of Dreams. And that's exactly what my grandfather instilled into me. And we have ourselves today, you know, I started out with maybe $1.8 million. Today we have about $600 million under management. And we just got a group of great people, 13 staff members that are out there to help our clients, you know, and sift through the nonsense and the noise that they hear, you know, whether it's the annuities or whether these are product-driven type of scenarios here. And we try and pound this home through our website and through any communique that fiduciary is the only way that you should do business in this business.
And everybody, again, we're talking to Tom Meyer, president of Meyer Capital Group in Marlton, New Jersey. And we're here talking about a fiduciary standard and why it's so important. When people come to your office, Tom, do they readily understand that you guys hold yourself to this high standard, or is it one of those things that you kind of have to preach to them and get them to learn about?
Oh, absolutely. We have to preach. And I can't tell you, I wish I had a nickel every time a potential client comes through our door and we go through their statements. To this very day, when they buy an A mutual fund for, we'll say, $25,000, they swear they didn't pay a dime for that mutual fund. So I always say, well, let me ask you, did you go in on free mutual fund day? I mean, let's face it, everybody deserves to be paid. Just be honest and forthright. You know, when they buy an A-rated fund, an A mutual fund, do you realize on the trade confirms there's nowhere in black and white that they actually paid a commission? That if they put $20,000 into a 5% loaded fund, that they paid a $1,000 commission, that there's nowhere that says they paid $1,000? Even after what we have been through, they still get away with this. And it's unfortunate to the client, because if it's not the loaded mutual funds, then it's bonds. I mean, that's a whole nother story, I guess, for another day. But, I mean, people still swear to this very day that they didn't pay anything to buy a bond.
Yeah, because they don't see all the backloaded fees, and it's just...
No.
And that's unfortunate. Well, and that's unfortunate. That I think kind of segues nicely into my next question for you. It's about the initiative that the consumer takes to be educated on these issues. People that you talk to, I mean, do they seem like they're out there, they're trying to do research, they're trying to learn about this? Because obviously the industry isn't doing enough. But are people? I mean, are they craving this information? I mean, and where are they going for it?
You know, for the ones that at least open their statements, Yes, I mean they do. They want to know about asset allocation. Our clients, we throw that in to the mix. We'll sit there and they'll either email us or maybe sit down with us each quarter, and we'll go over their 401k statements. Because quite frankly, even under the Pension Reform Act, I believe in 2006 it was, the companies are required to have independents come in and give some type of advice. The problem is these are very costly plans. Now, granted, the 401k really is a great thing. However, like you said, the onus is 100% now on the participant, and not enough goes into to at least taking the time to talk with each and every participant about how they should be structured. And because of that, like you said, they either have a lot of cash or they got a lot of company stock, and there's like nothing in between.
Right.
And a lot has to definitely be done.
And again, everyone, we're talking to Tom Meyer, Meyer Capital Group in Marlton, New Jersey. Just talking here about a fiduciary standard. And the next issue here that I'd like to actually talk about with some folks is kind of getting a better idea as to some of the real situations that you are coming across in your work every day with clients. And with $600 million under management, I'm assuming you've got a fairly large client base, and I'm sure that a lot of those clients have been impacted one way or another by brokers. And we're never saying that all brokers are bad. There's plenty of decent people out there who do in fact sell product. But what are some situations that you've come across within your own client base where they've come to you after the fact because they felt like they were wrong?
Outside of the rubber chicken dinners, I mean, obviously we don't have enough time to go into all of this, but right now in this market, the annuities are huge. Annuities and IRAs. I mean, talk about sacrilege. I mean, nothing gets my goat more than when I see annuities, these high-cost annuities stuck in IRAs. There's just no rhyme nor reason for that. And unfortunately, people go to these dinners, they get the G word, but they never have the time to look and delve into exactly what they bought. Right. It's almost like people talk about the subprime mess. Well, you know what? There's a big-time annuity mess out there, and unfortunately, the subprime's getting all the attention and press. But there's going to be a big-time problem when people understand how much they're paying, that they're locked in, and that there's no reason whatsoever that they put a tax-deferred vehicle into a IRA. It makes no sense whatsoever. So that's the biggest thing, and especially with the volatility today. People are going after that, what the interest rate, too late by the time they realize what they've gotten themselves into.
What do you think are some of the warning signs that people need to be paying attention to, that maybe they're engaged in a relationship that may not be in their best interest?
When it sounds too good to be true, walk the other way. And if we haven't learned that, throughout the years, whether it's a dot-com boom or whether it's a real estate bust, whatever the case may be, when the 10-year Treasury and high-quality bonds are getting 3.5% or 4%, how is it that somebody can give you 7 and 8 and it's a quality product? And I always say, hey, you know what, on an annuity side, and I'm not saying all annuities are bad, don't get me wrong, but I will say, remember, you're giving, if you feel so compelled by that company that's giving you the guarantee, well, then let me tell you, you're going to make more money in the stock than you would in the annuity when you're going to be locked up for 10 years. I mean, if you think about it, that company, the guarantee is only good as the company giving you the guarantee. And if you're so compelled to say that MetLife is going to be great, I'm just throwing MetLife out there, but, if you think MetLife is so good and they're going to guarantee you your money, then guess what? In 10 years, you're going to be better off buying that stock than you are that annuity.
But those
you're making money with your money.
Exactly, but those are the things that the consumers aren't really thinking about. And so that kind of circles all back around to the point where they've got to be educated. They have to know and understand the kind of relationship that they are going to be getting into.
Well, that's true, and remember, being not a fiduciary, more of a suitability, if you don't ask, they're not going to tell you. They're not required to tell you exactly what you're paying. You've got to ask questions. And the problem is people trust too easily today.
Yeah, and you actually said if they're not willing to put it in writing, then it's something you've got to be taking a close look at. Because, I mean, and NAPFA members, and you are a NAPFA member, have to sign that fiduciary oath. And it's a document that basically says, I will hold to a standard that I will keep true to you, that you're the client. It's about ethics and it's about morals. It's about doing what's in the best interest of the client. And NAPFA members are willing to put that in writing, whereas people at the large brokerages not only won't do it, they can't do it. they're prohibited from doing something like that. So obviously, asking for people to put it in writing will give you a clear indication whether or not someone's going to hold to that standard for you.
And let's not forget, there's no free lunch out there. Everyone is getting paid, and rightfully so. Everyone deserves to be paid. So if you're putting down $20,000 into a product, you have every right to know exactly what's coming out of your pocket. Don't go in thinking that it's a free lunch.
On that note, Tom, what I'd like to do is give you an opportunity to give us a little bit more information about Meyer Capital Group in terms of where people can reach out to you if they're interested in learning more about what you guys are doing for people, or people just want to learn more about your take on a fiduciary standard.
Okay, great. Thanks, Ben. We are actually located right outside of Philadelphia in Marlton, New Jersey. Our phone number is 856-985-8400. Our website is Meyer, MEYER, CG,
Tom, this has been my pleasure, and anytime you want to come back on, please let me know. I'd love to get you back on. I think people really are going to enjoy your straightforward, no-holds-barred kind of approach to the topic, so I certainly do appreciate it.
Thanks again, Ben.
Excellent. And everybody, again, that was Tom Meyer of Meyer Capital Group in Marlton, New Jersey. And again, I invite you to check out their website. It's www.meyer, that's MEYERCG.com. And I'll look forward to having all of you join us again next week on the Fiduciary Voice. Until that time, be sure to work with the financial advisor who holds themselves to fiduciary standards.